All right. Let's try that one more time. Welcome. This is the NewAge live stream. Always got to have something go wrong, right? So hope you guys are doing well. Let me just check in, make sure with the team, my trade analysis team on Slack, that we are good, and I'll get going. I have a lot to share with you here. Let me just check in with the team. And okay, sounds good. All right, perfect. Hey guys, welcome. So it is August 3rd, just after the bell here. 4 o'clock, very impressive market rally here. Let me just pull this over here, kind of get you caught up as to what is happening. Pretty amazing market comeback here that we've seen. So let me just blow this up just a touch here. You know, just a market that's just ripped back in the middle of earnings season. NASDAQ up 2.7% here. Let me just pull the full screen over. NASDAQ up 2.7, the S&P up 1.6. We had commodities off there a little bit. Crude, copper, lower, pretty good there. Crude lower by 3% at 90. That's amazing. One of the lowest crude prices we've seen in some time here. Treasury's up there a little bit. 30-year was up a touch. 10-year and 2, so that's the price of the bond. And the yields are going to move in the opposite directions. Commodities mostly lower there, and some big stock moves. So have a lot to share with you here at the top. You know, here's the list to my. This is going to be my left, and you know, we've come a long way in the middle of you know, right in the middle of summer, which traditionally can be a pretty slow period here. Sometimes you have busy summers, and sometimes you have slow summers where, you know, you all go to the Hamptons or the lake or the mountains or whatever you may do. But this is a busy one, and this is a good one. So, you know, I think the big thing that's coming along here, and again, let me just make sure one more time that we're good. And the market, yeah, we're good. We're rolling. Okay, so, you know, I think the big thing that we've seen is we've seen a huge sentiment shift, and basically we're coming to the idea. We're realizing, the market's realizing. I think, you know, I would say that we've known this, that the idea that inflation is not transitory, as Jay Powell told us a year ago. It's not transitory. It's not, you know, a fleeting in and out kind of thing, but it's not here forever. Okay, we're already seeing signs that inflation is starting to moderate. We're starting to see that reflect in where the Fed is expected to go in terms of rates. We'll talk about that. Earnings season, we have about 60% of the S&P 500 companies that have reported in, and they're not as bad as the people who are desperately vying for your attention, both on traditional media outlets, of which I'm a part, social outlets, written, whatever. A lot of people are trying to scare us out of good positions. That's a polar soda, I promise. And earnings haven't been that bad. We're going to go through Apple earnings. I'm going to show you some of the numbers there. We're seeing, I think, underweight positioning in a lot of portfolios, and that cash is rushing back to work into the market right now. We did rebalance on July 20th. We had approximately 18 to 19% cash in the NewAge Alpha portfolio. We put 12% of that to work. We still have 8% cash according to the model. A little bit more to put to work, but we did put some money to work, and we made the portfolio more tech-oriented. I'll show you what that looks like too. We also have right now going through Congress the CHIPS bill, which is the Inflation Reduction Bill. I'm not going to go into that here. I have a lot of feelings on that. $52 billion earmarked for U.S. Semiconductor manufacturing, $200 going towards other efforts, which is very much in debate, because spending another $200 billion sort of in this towards going towards green energy and improving the future outlooks of our energy security and independence seems kind of interesting, considering it was excessive spending that put us in this inflationary pickle that we're in now. But again, we'll talk about that later. I did CNBC yesterday. I haven't done it in a while, taking a break. They pulled me back in. Talked about a couple of stocks that were moving, Uber, Pinterest. Those are fun. A couple, one was an earnings move and one was an activist move, but both huge squeezes up. So that was fun. Did that yesterday, and that's that. So let's start to roll in here. I want to take a look first, as I've kind of been doing. It's all about the Fed, right? I want to talk about where the market is viewing interest rates at future meetings. So let me flip this over. Okay, so right now, if you have questions in there, let me know. Let me know if anything's popping up. Candace Cameron's in the house. Another great show. Thanks, Candace. I used to really like Full House when I was a kid. It's a spam comment. Okay, so here's Fed fund rates. Right now, we're currently at 2.25% to 2.5%. And what's interesting is we just had the July meeting, okay, and now we have all of August off, and then the next one is at the end of September. So there's quite a long gap. And right off the bat, this is what's interesting. It's 2.25% to 2.5% at the Fed funds rate. And remember, this is the short end of the yield curve. The Fed directly influences the short end, where the long end of the yield curve, longer duration yields like 10s, 20s, and 30s, are more susceptible to market forces, though the Fed did try to influence those by way of quantitative easing, which was in response to the global financial crisis. But again, they're trying to move the short end of the curve. And right off the bat, you're seeing there is a 56% chance that we're going only 0.5% higher, 275 to 30. 43% chance that we're going to go 75 basis points in September. Okay, so we're either going to be 275 or 30 at the lower boundary, but then we go out to November. Look, we're 3 to 3.25 at the lower boundary, so 46 and 45, so it's like 90% chance we go to 3.25 to 3.5. But then look what happens when we got to December, 3.25, 3.5. We have a 45, so we have a 65% chance that we stay at 3.25 to 3.5, and only a 30% chance that we get up to 3.5. So what they're saying is after the next two meetings, September, November, we get up to 3.25, 3.5, but then the way the market stands now, even with the strong rally that we've seen, there's only a 30% chance of going beyond 3.5%, only in the federal funds rate. So, that's pretty interesting that we perhaps have reached the terminal federal funds rate. And the market has known this for a while. So it's not the absolute level that makes investors afraid. It's the pace at which we go to maybe an undetermined point in the Fed fund rate. So we know the pace, we know where we're going, and markets kind of take some comfort in that, in knowing where we're going. So let's take a look. I'd like to move over here to the tips. So Treasury inflation protected securities. So this is where the markets are pricing inflation 5 years out. So back here, this was in March of 22. We were up around 3.6, give or take, percent inflation. But since March, we've dropped away sharply, all the way down to 2.7%, and that's expected on the 5-year. And then we could even go to the 10-year quickly, which is 10-year tips break even. It's going to be even lower. We're going to be down to, actually, we did back up here a little bit, 2.4, 2.5 area here. So that's fine, because, all along, even when the Fed was wishing and begging for inflation above 2% on a sustained basis, so we don't turn into Japan, which is deflation. They're suffering from deflationary forces. that were begging for sustained inflation above 2%. And then we flipped the other way because of the pandemic response and some other things were happening. And then we got 6, 7, 8, 9% inflation. They said, oh, be careful what you wish for. But if you look at that TIPS market, it's looking to moderate out between 2.5% and 3% right now, 5 to 10 years from now, which that's what the Fed wanted all along. Okay, so everybody's starting to take a little bit of an exhale based on that. Okay, so let's take a look at some commodities. And I'm going to go through here again. Over on my list, I am going to go through the stock indexes. I'll show you where we are, but I do want to kind of round out this conversation on commodities. And let's go right here. So I like to watch. Let me get rid of this monthly and. Oh God, is the volume too low? Sorry, let me get up Slack. I see you guys talking to me. I can turn it up. Audio mixer. There, I'm turning that volume up a little bit. Looks like my guys are saying it's low. Slack. Okay, on sound, guys. Okay, so I'm going to keep pushing forward here. Again, inflation and commodities. So I like to watch this Bloomberg commodity index. It kind of takes the place for us from the CRB, those of you who've been around a long time. So this is the move that we've seen in a basket of commodities. We topped out here in March, sort of did like a triple top. That's kind of a pattern that my buddy Larry Pesavento calls 3 drives to a top. Backed off sharply, came back to the 50-day moving average, and it looks like we're starting to settle in there a little bit. So commodities have come off. Let me just go through a few of the big ones. Meats have been strong. There's specific reasons in the middle part of this country, specifically a lot of friends we have in Texas with meats that they've given us some heads up. But if you get off of meats, you go to cotton, you go to coffee, you go to wheat, you go to corn, go to cocoa, you go to soybeans, they're all dropping sharply. You go to sugar, there's crude oil breaking back below 90. That's pretty interesting. Natural gas continues to be very strong. I do think we break out there. We put some natural gas exposure to work. And lumber making new lows. Interesting in a housing sort of bubble that they tell us in there that we're in. Silver still in a downtrend, but it's come back. RBOB gasoline off. That's interesting as well. Gas coming off. So commodities have come off quite sharply. And again, that is leading into taking some of the pressure off the Fed because obviously commodities moving up are going to increase the CPI and other pricing gauges, and that's gonna take the pressure off the Fed to raise. Okay. We're also going to talk about that GDP report that came out that gave us 2 consecutive quarters of negative contraction. I want to look at the specifics there. Okay, team from Trade Analysis says we're good. So let's take a look at that GDP report here quickly. I find this interesting. So here's the data and GDP. So in June, this is real GDP, advanced GDP. We contracted negative 0.9 after we contracted negative 0.16. Okay, let me just pull this over here. I know you're cutting off a little bit of the screen there. There we go. Okay, so 2 contractions in a row constitutes the definition of recession, and the politicians are having fun with calling, maybe they're saying, well, it's a contraction, but it's not really a contraction. And normally I don't like the political games that are being played when it comes to the economy, but in this case, I kind of agree, and here's why. There's two reasons for that. Take a look at this, before I set this up, take a look at the growth, okay, that we've seen over the last 4 or 5 readings. 6.9, 2.3, 6.7, 6.3, 4.5, and then this is the sharp, obviously, COVID reaction, down 31%, snapback plus 33%. But then I'm focusing in on these guys, and I put a tweet out, and I put this chart together, which I think is pretty interesting. The 85-year average of GDP growth is 3.17%. Okay, 3.17% average growth in the U.S. quarter over quarter. If you take a look at the growth that we saw post-COVID lows, it averaged 5.34%. I mean, that's like 70% above average growth. We had very strong GDP growth for 1, 2, 3, 4, 5 quarters. So then to pull back 1.6 and 0.9, I don't consider that bad. I really don't. I think that's to be expected when you have above trend GDP growth like that. Now, granted, the Fed and the fiscal and monetary policy stimulus was, will be read about 100 years from now. Hopefully, when my great grandkids are in school, and hopefully they're not still paying for it. But to have some kind of contraction, I think is fine. And then if we get into the details of why we contracted. This is the actual GDP report, and you probably feel like you're back in your economics class, but that's okay. So this is the actual GDP report, and specifically what happened was a reduction in private investment, and what that means is inventories. Okay, so this table we're looking at is contributions percent change of real GDP. How much each one of these things, these factors, impacted the percent, what percent impact they had on GDP. So let me just make sure I can scroll in here enough and you guys still see the screen. That's pretty good. Okay. So GDP in Q2 of 22 contracted negative 0.9%. Okay. So personal consumption expenditures up 0.7. Goods took off minus 1.08% goods. But what's interesting here is this one, gross private domestic investment, dropped 2.73% from the GDP. And specifically, it's this guy right here, private investment. Where did she go? I had it, sorry. Net change in private inventories right here, negative 0.2% change in private inventories. That's businesses not investing in future inventory. They already have an inventory buildup. So okay, so there was a little bit of a pull ahead there, and that could explain why we saw above trend GDP growth for 5 quarters, and that's why the market was doing so well. But if you get into some of these earnings reports that we saw, it's not so much that there's an inventory buildup in everything. There's some goods that businesses built up well ahead of time that were in demand during the pandemic. Those are sitting on shelves, and they're going to have price reduction in order to move those in the future. So that's disinflationary, right? But there are other products, and there's other specifically services that are in demand coming out of the pandemic that will contribute to GDP. So, you had 2.7% impact on gross private domestic investment, and specifically 2% change in private inventories that drag GDP down to negative 0.09. So, it's nuanced if we're in recession. Okay, I hope that makes sense. Okay, so the other thing I want to show you guys is going in order here is, I hope I was sharing that screen right there. Yeah, I think I was. Okay. The other thing I want to show you is wages and salaries. This is also, it was inflationary, but now I think it's actually more deflationary. Okay. So wage pressure. We can't get people to work. We still have 3.5%, employment. Let me pull that chart over right now. Unemployment's 3.6%. Wages going up. Can't get people to want to go to work. I'm not speaking generally. I mean, there's more job openings than people are willing to go to fill those jobs. So fine. And they're saying those wage pressures, in order to get people to come in, are also contributing to inflation. Well, the good news is we're seeing a sell-off in U.S. wages and salaries. So we spiked out at 15% year-over-year growth. We just got cut in half to 10% year-over-year growth. So I mean, it's still a lot, but we're coming off. Okay, that's a massive, massive spike, and that was the maximum. This data series goes back to 1960. Huge spike right there. But you could also argue that people were underpaid for a long period of time, and this was mean reversion, so that's good. Okay, but wages are coming off, and there's other evidence right now that job openings are also coming off. Okay, and again, just to take a step back, these are all reasons why I think the Fed and the market is comfortable topping out at 3.25, 3.5 Fed funds rates, because as I mentioned earlier, commodities, wage pressure, job openings, as I'm going to show you here, job openings are actually starting to come off. So this is the JOLTS jobs opening. We had a prior revision 11.3. We're looking for 11, and the most recent was down to 10.7. So we're actually seeing below expectations. We have less job openings. It was below expectations. And then as we head into the end of the week, we have non-farm payrolls. Now that's going to be interesting as well. We have the participation rate, private payrolls, average hourly earnings. We get some pricing data there. So watch out for that Friday. But on the wage side, I think we are coming off as well. Okay, so earnings update. We are now mostly through earnings season, and this is from FactSet. This is a quote. In July, analysts lowered their EPS estimates for third quarter by larger margin than average. And basically, what they're saying is the first month of every quarter, there's a history of analysts dropping their earnings expectations. So for all companies, we decreased earnings expectations by 2.5%. Okay, so what we're looking for next quarter dropped 2.5%. From $59.44 to about $58. So that's all S&P 500 companies dropped 2.5%. Okay, and if you look at the FactSet, okay, let me pull this over. If you actually look at the FactSet, I thought this was interesting. This is the chart from FactSet. This guy, John Butters, he puts out great work. It's free. Check it out on the website. So this is the 2.5% earnings revision. I can't help but think, when was the last time we saw such significant earnings revisions? That was back in 18, 19, and 20. What was happening back in 18, 19, and 20? What would cause analysts to drop earnings revisions? Think about it. There's two things happening. There were Trump tariffs going on, and the Fed was raising rates. Okay, what happened in 2018 and 19 heading into COVID? Well, the market was sideways 19, and then here's the end of 19, and then we get into 20. We had tariffs, we had Fed raising interest rates, and Trump was bitching and complaining about it, about Fed being too aggressive, and he was hammering Jay Powell. Actually felt bad for him. He was destroying him in the media. But the market broke out anyway. The market broke out strongly, and then we got hit by COVID. So we had earnings revisions last time for those two reasons, but the market broke out anyway. So I can't help but think, is the same thing happening again? Okay, so my friend Tom Lee put this out, and I hope he's okay with me putting this out there. I subscribe to Tom Lee. I'm friends with him. I have a huge amount of respect for his work. Really good stuff in here, and here's the data that he can put in front of us. Okay, so again, Tom, I hope this is okay. I recommend you guys subscribe to his service. I really like him. 335 of the 500 companies, 335 reported 67% of the S&P earnings are beating estimates by medium 7%. 74% are beating those estimates. So FactSet told us, okay, we have obviously decreased expectations for next quarter, but in Q3, for Q2, 67%, or sorry, 70, what am I saying? okay, 68%. That's the number I'm looking for. 68% of those are beating estimates. Okay, they are reduced, but they're beating estimates. And they're beating on average of 5%. Okay, so as of June 30th, the S&P 500 so far, we're looking at $54 per, this is the aggregate earnings of the S&P 500. This was the consensus of 54. Right now we're at $55. Okay, so we have a 1.4% change. Okay, so 74% of the companies are beating. And then Q2 earnings results 2.1% surprise on the upside. Absolute, and again, I got to get into the details there a little bit. And some of the weaker sectors, the weakest is actually communications, which I find interesting. At 57%, companies are beating. So comms continue to be weak. And then materials and, yeah, that's pretty much communications basically stick out there. Okay, so what does that mean? Okay, so we're like $55, $56 expected in the S&P 500 aggregate earnings. So if we look at Q1 of 22, we're expected to make 45, or 47, we made 46. But then if we go to Q2, this source from Y charts says in purple, the forward earnings is 51 for Q2. Forward earnings for Q3 is now 55, and I think that matches up. And then we're looking for 57, a little pullback there to 54 in Q1 of next year, but then up to 55, 58, and up into the 60s for forward earnings. Okay, so earnings are continuing to expect it to increase, and that's just going to be bullish for the stock market. Okay, how are we doing? You guys all right? And then, hello, Todd. You called Bitcoin. I was there 19,000 a year ago, spot on, 18 daily close, June 18, exceptional work. Thank you very much. I don't remember that, but thank you. Okay, all right, so let's take a look at Apple. And I did a little bit of earnings work here, and I got a client coming over here in just a little bit, so I'm still on the live stream. If you guys get here, I'll be done quickly. Okay, so let's just take a look here. I want to look at these Apple earnings, and I did a little spreadsheet work for you. Look how dorky I can get. Let's do this. Okay, so these are Apple earnings, and Apple's just been an absolute tank. All right, so the way you break it down with Apple is products and services. Products are $63 billion in revenue, where services are only 19. So obviously products are a lot bigger. But if you look at the margins, okay, the margins on products was 34%, where services is 71. So double the margin, right? And if you look at how Apple operated, okay, and there's a couple examples in here. Tesla's another one I want to do an earnings deep dive on here. But let's take a look at these numbers really quick, okay? So if we look at cost of sales, okay, 3 months ended, so this quarter, 3 months of 22 compared to last quarter of last year, and then last 6 months versus last year's first 6 months. That's how these two are broken up, 3 months and 6 months. You look at the products margin. Quarter over quarter, okay, we went 34%. Okay, so we were at 36, we went to 34. 6 months over 6 months, our product margin actually increased. So we dropped product margin by, that should be a negative, by 1.5%, okay, because input costs went up, right, this quarter. But 6 months, okay, products margin was 34% compared to last year with 34% compared to last year at 36%. So their margin dropped by 1.5%, but the 6 month actually increased 35.6 to 36.7. That's amazing. So in an increasing input environment, 6 months, our product margin increases, and that's not even the best part. The services is where it gets interesting. Services, we increased their services margin by 5.8%. Their margin went from 69 last year to 71. But look at the growth in revenue, So you have 5.5% increase in cost and services. The revenues increased 12%. So you have costs going up by 6%, and the revenues on services going up by 12%. That's amazing. Okay? And if you look at it on a 6-month basis, the services margin, 72%. So we went from 69 6 months ago last year to 72, and then we had revenues growing. We had revenues growing 17%. 6 months last year compared to the 6 months this year, 17% increase in revenues, but your costs are only going up 7%. It's amazing how Apple is controlling those costs. So altogether, you put products and services in there, gross margin of $35 billion on $63 billion, or no, sorry, revenues were, I wrote revenues down. We could just add that up, 63 and and 41. So there's your total revenues. Your margins went to 43.26, quarter over quarter, basically flat. Analysts were expecting those margins to go to 42.61. So they came in well ahead and basically ran the same overall gross margins they did last year, and they increased by a solid 2.4%. The first half of last year versus the first half of this year. So talk about a company that's just controlling margins extremely well. And another one that did it really well is Tesla, and Tesla is reacting as a result. So this is the thing that's happening right now. And it's a big reason why we're seeing a big rotation into growth, because they can control those margins so well, where a lot of other product heavy and input heavy industries are obviously going to be impacted by the current environment. Okay, so let's do this real quick. Let's do an update on where we are from a technical point of view. I'm going way over on this as I usually do, so I'm going to be fast. So this is going to be the NASDAQ. Okay, I'm getting a little hairy with the technicals here. Okay, I'm going to save you some of the gory details, but this has been the decline from November 21. Okay, and we use a pretty specific niche, esoteric kind of way of labeling these different corrections and trends. But basically, the line in the sand and the real decision point if this is a corrective rally that sells off sharply, I think it's going to be right here at the 50%. What that means is basically the percent decline from November to April or November to June. Take half of that, and that's going to be right here at about 13,500 to 600 in the NASDAQ. Okay, the NDX 100. That's going to be the line in the sand. If you break through that, you would have broken this white line, which is resistance, this blue line, which is also resistance, this guy is resistance. If we break through that, I think we're off to the races, and I think we can absolutely secure the lows. As I said, we put some cash to work on July 20th, which is right here. Kind of bought this breakout right here above this resistance, expecting the market to go to work. And that was, again, after sitting with cash throughout a lot of the decline. So that's the NASDAQ. Here's the S&P. Same situation. This is going to be a big resistance level in the S&P at about 4160 to 4170. Okay, there's a lot of resistance in this level. If we can poke up through there, I think we can secure the June lows and say that that's it. Okay, and say that this is this huge pullback that everyone was so afraid of. Investor sentiment was the worst in 7 decades, and positioning was so extremely light, and oh my goodness, it was just it was amazing how emotional the sell-off was. In the grand scheme of things, guys, it might have just been just a little sell-off that we've seen several times before in the rally since 2009. Okay, and I like to kind of do this. Sometimes you just take a step back and you say, okay, let's just take a look at the long-term chart. Let's go down to a monthly, up to a monthly here. and just take a deep breath. Let me just get as many of these lines off of here as I can. And you look at where we've been since the 60s and 50s, 60s, into the 90s and 2000s, sideways, and then we moved up, and everything we just freaked out about was right there in the context of where we are. It's pretty amazing. Okay, moving quickly to NVIDIA and semis. One of the telltale signs that we use to declare or to suggest, I should say, that a bottom is in is this move, which is a 5-wave move according to the world of Elliott, which basically what that means is if this correction here does not move into the territory of the first correction. So you put in a low, you move up, you make a higher low, you then get a nice gap, move up, and then if this correction doesn't overlap the territory of this correction, that's the sort of an early sign that a low might be upon us. And again, if you just look at where we've been, that little analysis I just showed you is all contained in here. But, you know, nice little pullback here after a very sharp rally in NVIDIA. And this is the case with several of the semiconductors. They're leading the rally up. And we've increased exposure in a lot of tech stocks and specifically chips. AMD had earnings that did miss. They were off a little bit. I think they closed down slightly on the day, which is fine. But NVIDIA was still up. AMD closed down one and change, where NVIDIA was actually up on the day. NVIDIA should be here somewhere. NVIDIA was up 1.5%, so that's fine. Okay, let's go into some portfolio adjustments. And this is going to go to clients of NewAge Wealth. I'm going to send you guys in your client portal, I'm going to send you the new updated portfolios, both the NewAge Alpha and the Tactical Dividend, and you'll see all the changes that we've made as of July 20th. But let me just go over that quickly again. I should have that off to the side, but if not, I can pull that up very quickly. Portfolio tracker. Okay. So starting off with the growth, again, these are the moves that we made. The biggest adjustment in the growth, or what we call the alpha, was an increase in technology. Okay, that was July 20th. We went up 9%. We now have a 43.25% allocation. At the time we readjusted to technology, I think we're seeing, and so far it's been proven correct, a rotation into growth. So we increased allocation in technology, consumer discretionary, which is also linked to growth, as well as communications. So we increased 15% between those two, and we decreased exposure in financials, industrials, energy. We cut by 5%. Okay, we're still overweight. We still have a 7.25% allocation energy, which we benchmarked this guy against the NASDAQ. NASDAQ doesn't have energy exposure, so we're way overweight to the NASDAQ, but we still have 7.25%, and we're actually, based on earnings that we're seeing from energy, I think we need to continue to divest out of energy. So I think it was the right move. And I'll get into some of the specifics. That's just a couple of the holdings just flashing for non-clients. And I'm going to send those out to all clients. Going over to the tactical dividend, the adjustments, again, you're going to see a similar thing. Increase in technology by 4.5% to go to 28% allocation in tech relative to the S&P. Oh my God, I'm not showing this. Let me do that again. Members, clients, I should say, you're going to get this anyway. Sorry. I'm sorry I wasn't showing it. But here's a quick screenshot of growth, and you can stop it and look. Adjustments are technology, consumer discretionary, communications, and a drop in energy. Then over here to dividend, similar. Technology, consumer discretionary, and communications were increased, while energy was decreased, financials were decreased, and the other thing was cash was decreased. We dropped. We had about 5% cash level, a little bit more. We dropped by 3.5% in dividend, as well as growth. We dropped by 6.3%. Okay, I have a client showing up, and I'm going to go through future videos, guys. We're going to go through some of the stocks, specifically like we did with Apple, technicals, a couple stocks we added to the portfolio. I want to talk about Ford, big move out of that. So thanks for listening. Hope that made sense, and I will see you guys on the next video update, which I promise will be more frequent than this. I've been a little bit more in markets mode